Welcome to the Ackermann Group podcast. Let's dive deep into the industry insights of the multifamily, real estate investing, and property management world as we establish Ackermann Group at the forefront of industry change. Hi, and welcome to Ackermann Group, the podcast. Today we have Alex Cole, our acquisitions manager, here to give us a quarterly market update. Welcome to the podcast.
Thanks, Lily.
Yeah,
Happy to be
welcome
here.
in. You want to give a little background about what you do at Ackermann?
Yeah, sure. That's great. So as you mentioned, I'm the acquisitions manager. So my days consist of going out trying to find new deals for us to buy and valuing them, making offers, and trying to negotiate the price. And then after that, I lead the due diligence process as well.
Nice. That's awesome. Yeah. Do you want to just start out by giving kind of a brief intro into our target markets?
Yeah, sure. So broadly, we're looking for secondary and tertiary markets in the Midwest and the Southeast. We find that there's a lot of stability in those markets and a little bit less competition. Mm-hmm. And then specifically, we're focused on Cincinnati, Columbus, and Indianapolis in the Midwest. And in the Southeast, we're looking at Lexington, Kentucky, Knoxville, Tennessee, Chattanooga, Tennessee, and Greenville, South Carolina in the Southeast.
I'm very excited for us to expand and get into some new markets.
Me too.
I'm excited to get down there. I'm like, yeah, let's do it. Me too. Cool. Do you want to talk a little bit about multifamily performance during this last quarter?
Yeah. So nationally, rent growth for the first half of 2024 has been pretty slow. So far, rents have increased about 1% during the first half, and occupancy has actually declined to about 94%. During the peak kind of post-pandemic years, rent growth was up nationally, was up to about 11%, and occupancy was up at around 96%. So one of the reasons we like these secondary and tertiary markets is our markets have generally outperformed the nation, not by a huge amount, but about 60 basis points better on rent growth, and our occupancy is about 40 basis points higher than the national numbers. So, and oddly, very much different than how things were pre-pandemic and during as well. The Midwest markets have kind of led the way in rent growth, and I think that's just another reflection of those markets is very steady. You know, whatever's going on in the national economy or the national multifamily in the national multifamily world, the Midwest markets just kind of perform and give you steady rent growth.
Yeah. Do you know what some of the key factors might be that are driving these trends?
Yeah, actually, there's one other thing I'd like to touch on.
Yeah.
That's near and dear to my heart. It's transactions. So multifamily performance from a transaction standpoint is at its lowest point in 10 years. Mm-hmm. So that's in crazy. The first quarter of 2024, $20 billion worth of multifamily changed hands. And that's down from $166 billion in the first quarter of 2021. So the transaction market has really slowed down, and we can talk about that in the next section. But that's just another trend that I follow very closely. Yeah. So some of the key factors driving the current trends are the main one: supply. Right. So when occupancy and rent growth were hitting record highs across the nation in 2021 and 2022. There was a subsequent increase in new construction. So in 2023, about 440,000 new apartments were built in America, which is a 36-year high. And that number is going to increase to 600,000 in 2024. So there's this supply wave that is hitting the industry right now that's keeping occupancy low and keeping rent growth low as well.
Yeah.
So this elevated supply is hitting us now, but we see that slowing down in 2026 and 2027 because interest rates have been persistently high and construction costs have been very high as well. Mm-hmm. Now, the reason we have these record inventory growth in these past 2 years, but the reason we still are getting some positive rent growth is jobs and the economy as a whole. The economy has continued to add jobs, and because of this, demand for multifamily housing has rebounded, and most of this new product has been absorbed now, albeit not at the rates or at the high rents that developers would have liked. But people are still moving into new apartment communities. Mm-hmm. And then I mentioned lack of transactions, and in the earlier part of this. But to be straightforward, it's a very tough market to sell into. Valuations are down, borrowing costs are high, and capital is increasingly picky. So right now, when people are selling properties, we generally see two different types of sellers. Ones that bought their assets before the pandemic, have a very low basis. They've completed their business plan and they're going to do very well. Or we don't see as much of this, but groups that bought at the peak in 2021 on floating rate financing, and their debt's maturing, and they basically have to take the best offer or try to do a cash in refi.
Yeah. I know you've talked a lot about, the last quarter and what we've seen. What do you see coming up for the rest of 2024?
Yeah, this might be me just being hopeful from my perspective, but I hope that the transaction market kind of unfreezes, and I think some clarity on interest rates and some more loans maturing will allow the transaction market to pick up, and more deals will get done, and valuations will become a little clearer. And then from an operations standpoint, which is not necessarily my forte, but our markets and our properties are generally pretty steady, and I think that will continue, and we'll start to see even more improvement as the supply wave slows down.
Yeah. I know you guys spend a lot of time kind of, evaluating what's happened in the past and using that to make predictions for the future. But how are you kind of using these forecasts to make decisions in the now?
Yeah, from an investment standpoint, we need to be patient, but we also need to be flexible. I mean, we talked about valuations being down. For a long-term investor like us, that provides a great entry point. So I think that while we do need to be patient, we also need to be flexible and find the deals that get investors excited. I mean, right now, the transaction market is really slow because ultimately a lot of deals aren't providing the type of returns that get investors off the sideline. So that's going to change here in the next 12 to 18 months. And I think we're in a great position coming out of this rough patch because we have a reputation intact, and we have a very clean portfolio. So all the capital providers still, have faith in us and have faith in our company. And yeah, when we come out on the other side of this, we're being a great spot to be aggressive and find the right deals when they come along.
Yeah. I'm super excited to see our growth for the rest of the year.
I am too.
Yeah.
Absolutely.
Well, thank you for being here today.
Thank you.